Should you buy now or should you wait? Are you one of those sitting on the sidelines waiting for a massive housing crash to happen or waiting for this massive wave of foreclosures to hit the market so you can buy a property really cheap? Or maybe you're a little bit more reasonable and you think that interest rates are going to rise over the next couple of months and that's going to bring home prices down. Well, in today's video, we're going to talk about what that means. How does that translate into monthly payments? We're going to talk about what interest rates look like at the moment based on home prices now. And we're also going to put some predictions into play. A lot of the major associations out there, like the Mortgage Bankers Association, Fannie Mae, they have predictions on interest rates. And we're going to talk about their predictions and how that translates into monthly payments. So if you're considering buying a house or you're sitting on the sidelines waiting, this is something that you should pay attention to. You should know how interest rates affect your monthly payment. Just because home prices go down doesn't necessarily mean your payment is going to be less. And that's what I want to show you in today's video. Now, as a real estate agent, I know there's going to be people out there saying I'm just using these figures to get you to buy a house. And the reality is I just want to provide you with useful information that you can use if you're considering pulling the trigger as a first-time home buyer. If you're sitting on the sidelines wondering whether you should buy a home. Over the last couple of years, as you could see, waiting has cost you not only in appreciation lost, but also in principal payments lost. Every single month you make your mortgage payment, you're actually paying down the principal of that loan, which is almost like a forced savings account. So you're paying down the balance of the loan, and you've gained appreciation if you've owned a home over the last couple of years. So waiting has actually cost you money. So as a buyer, at the moment, should you sit on the sidelines and wait? Or should you get in the market? Well, that's what we're going to discuss in today's video. We're going to show you those examples, as I mentioned, and then you can use it and decide whether or not it's the right time for you to buy a home. As I led into a little bit at the beginning of the video, I'm not one of those housing crash believers. I don't believe a lot is going to change in the housing market with regards to values, but I do believe rising interest rates can cause buyer demand to slow, which would allow inventory to increase, which could give buyers more opportunity, which means less craziness when it comes to home pricing, less multiple offers, maybe some price reductions in some markets where prices have far exceeded what those homes are worth, which could give you an opportunity to take advantage of the market. Now, for today's examples, we're going to use a $350,000 loan amount and a $750,000 loan amount. Now, depending on where you are in the country, it might seem really low or really high, but I'm just using these to give you an example of where interest rates are today, how that affects monthly payment, and then we can talk about the future of what interest rates might look like and how that affects the monthly payment. We can talk about the differences in the two to give you an idea of what it might look like by waiting. Whether home prices go up or home prices go down. We're going to give you the examples of both. Now, for these examples, we're using interest rates based on those with higher credit scores, 20% down payments. Now, if you don't have 20% down or your credit's not as good, don't think that you can't use these numbers. The numbers are just based on the interest rates today. If interest rates go up, interest rates are also going to go up on those loans as well. So just use these as some sort of basis to give you an idea of how, monthly payments are affected by rising interest rates. So example one, $350,000 loan amount based on an interest rate of 3.25%, which is essentially where we are today. That's going to give you a monthly payment of $1,523 per month. Now, we can say, okay, over the next couple of months, home prices are likely to appreciate, right? We're headed into the spring selling season, if you will, more inventory on the market, but increased buyer demand most likely to happen. And so you're likely to see some appreciation over the next couple of months. So if that $350,000 home appreciated by 5% over the next couple of months, which based on last year would be really, really low, but let's just say 5%, that $350,000 loan amount would become $367,500. And let's just say a lot of people out there are predicting rising interest rates. So interest rates are going to rise, which I don't believe interest rates are necessarily going to follow the examples that we use here. But let's just say at the same time, interest rates go up. They go up to 4%. Well, that monthly payment is now $1,754 per month. That's $231 difference from where we are today. So if home prices increase by 5% and interest rates go up, not likely for both to happen, but at the moment, we've seen home prices continue to appreciate. We've seen interest rates move a little to the upside. And so that would be, again, $231 per month, which translates into $2,775 per year. So you're paying almost $2,800 more per year by paying a little bit more for the house and also having a higher interest rate. Now, keep in mind, during that same time, if you bought the house today based on the numbers that I gave you, you're paying almost $6,900 per year towards the principal on that loan. So you're paying down that loan $6,900 every year. And actually, it will increase every year. So that's like a forced savings. So you put some money down, you're paying down the principal balance, your equity is in theory growing, and you're getting mortgage deductions, you're getting something for that money versus renting every month. You're paying someone else's mortgage, you're not getting the benefits. You're paying, they're getting the benefit of the appreciation and the principal being paid down. But that's neither here nor there. So let's use that same example and say that values decreased. Let's say values decreased by 5% over that period of time, but interest rates increased. Now that $350,000 loan is now $332,500. And an interest rate of 4%, that's a payment of $1,587 per month. That's still $64 more per month, which equates to $768 per year. Now, I realize for a lot of people out there, that's not a lot of money, but what I'm trying to show you here that just by values going down, with interest rates going up, there's not really the savings that a lot of people out there are expecting to see. And who's to say that the market doesn't appreciate by more than 5% during that period of time? Maybe it doesn't depreciate at all. Maybe home values go up and interest rates continue to rise, maybe not at the same pace, but they do go up. You're going to end up paying more money to purchase the property and more money per month to own that property. Now, I want to be clear here, as I mentioned at the beginning of the video, before we talk about the $750,000 example, I don't necessarily believe interest rates are going to go up to 4%. I think you're going to see interest rates rise, but I don't think you're going to see them rise that much. And in fact, I don't think you're really going to see interest rates rise probably until after March or April of this year. The Fed did come out and say that they were going to stop tapering, that they were planning to raise interest rates 3 times in 2022, but they weren't planning on starting that rise in rates until the tapering had fully completed, which isn't expected to happen until March. So the tapering is going to end in March, at which point they are going to start raising the Fed funds rate, which isn't your 30-year fixed rate. So just because they start raising the Fed funds rate doesn't mean that your 30-year fixed rate is necessarily going to follow suit. Just because they raise 0.25% on the Fed funds rate doesn't mean your interest rate's going to go up 0.25%. And that's something that a lot of people get confused about. The short-term rates that they're talking about is more towards credit cards, borrowing money, banks borrowing money from each other, if you will, versus you borrowing money from the bank. Now, I'm not going to get into detail here, but understand, just because the Fed raises short-term interest rates 3 times next year, assuming that's what they actually do, that doesn't mean interest rates are going to rise on the 30-year fixed mortgage or the 15-year fixed mortgage by that same amount. So keep that in mind. But when you do start to see a rise in interest rates, it's not likely to happen right as we move into the new year. It's going to be a couple of months before you really see that take hold. And the question is, why are they doing this? Well, part of it is because they need some ammo. They need some ammunition if the market turns south again. At the moment, they don't have any ammunition, right? The market isn't necessarily doing the best out there, but it's doing a lot better than it was 2 years ago. And, what they need is some, again, I'll use the word ammunition. If the market does turn south, say the virus continues to get worse or inflation continues to get worse and things happen on their side, they need to be able to, have that ability to lower the Fed funds rate again, potentially start buying mortgage-backed securities, mortgage bonds again, in order to lower interest rates if something major does happen in the future. So they're kind of doing what they need to do to get ahead of a potential disaster in the future. Now, that's another conversation. But just wanted to throw that out there. If you're considering buying a house, that doesn't mean interest rates are necessarily going to rise immediately. It might take some time to do it. But again, let's talk about that $750,000 example. So today, $750,000 based on that 3.25% is going to give you a mortgage payment of $3,264 per month. Now with that example, every single month you make your payment, you're paying $1,232 towards the principal. Every month it's a little bit more, which essentially equates into around $15,000 in that first year that you make your mortgage payments. You've paid that principal down $15,000. So not only have you gotten a mortgage deduction, not only have you gained potential appreciation in that property, which we're going to talk about here in a minute, you've also paid down that principal balance. Now let's talk about what happens again if the market appreciates by 5% in the spring and interest rates go up. You're talking about a loan amount of $787,500. That mortgage payment at 4% is $3,759 per month. That's $495 more than it is at the moment. So if prices rose by 5% and interest rates went to 4%, $495 more per month, which you can do the math, that's almost $6,000 per year. So you're paying significantly more money in that example. Well, let's talk about what happens if the market depreciates. The values come down by 5% in that example. Well, that's a $712,500 loan amount in that case. Again, we're going to use that interest rate of 4%, which gives you a payment of $3,401 per month. Now that's a $136 difference from our original example, which is $1,638 per year. So even if values came down by 5%, but interest rates went up, you're still paying more money for that property. Now, as you can see here, there's a lot of variables in this equation, right? I mean, values could go up, but interest rates could stay the same. Values could go down, but interest rates could stay the same. There's a lot of different things that can happen. But, the most likely to happen is that values go up in the spring, and at the same time you see interest rates rise. But I wanted to give you some examples showing you both so that you have an idea of what to expect. Now, as I've mentioned many times in the past, values aren't going to continue to rise forever. At some point, you do have to see a pullback in the market. You have to see some sideways movement. But the question is, when does that happen? It can't happen until supply exceeds demand. And at the moment, we're not there. But if interest rates do rise enough, that could slow buyer demand enough to get inventory, the supply to rise, which should slow the housing market. But that's not going to happen overnight. It's not going to happen over the course of a month. It's going to take several months. In some cases, maybe even years for that to correct itself. So I just want to set proper expectations. If you're out there looking to buy a house, just know what to expect. If you have that longer term time horizon, you have money in the bank, you're comfortable with your monthly payment, you likely have nothing to worry about. So just keep that in mind if you're planning on buying a house. Now, if you're watching this and you found any value in the content at all, I'd like to ask a favor. Do me a favor, hit that thumbs up. Feel free to subscribe to the channel if you want more information like this. So hopefully you found some value in this content today. But maybe you're wondering, how do you take advantage of super low interest rates? How do you get the best interest rate out there? How do you even find a mortgage broker or a real estate agent to work with? Do me a favor, click this link in the description below. I can connect you with one of my experts, whether it's the mortgage field or the real estate field, to help you, get connected with somebody that knows what they're doing, someone that does business the same way I do, somebody that I know personally. And at the same time, if you're wondering why the interest rates you're hearing on the radio or the TV are way lower than what you're getting offered by your mortgage professional, do me a favor, check out this video here. I describe it in more detail so you don't get fooled. But for now, I appreciate you taking the time to watch. I appreciate all the support. Hope to see you again soon. Have a great day. Bye-bye.